I checked every area in against what's actually happening on the ground right now. Every single number has moved. 2.36 billion dirhams in listed price cuts sitting into the buy market right now. Entry prices in key areas are down to 10 to 15% from their peak. 65,000 units arriving by the end of this year. The guide was built on a different market. You're making a decision in this one. My name is Mohsin Imran, and I've been in this market for almost a decade. I work with international buyers with serious capital, above $3.5–5 million. I've closed deals in every area that I'm about to cover. I know the service charge schedules. I know what landlords actually net, not what's in the brochure, not what's committed in a sales meeting. In the next 10 minutes, the real net yield in 5 areas. Gross minus service charges at corrected 2026 entry prices. Which areas are carrying supply risk into the second half of 2026? And my direct verdict on the area that I would buy today. So let's dive in. Here's what actually changed. Between early 2025 and right now, the buy had a correction. Not a crash, a correction. 2.36 billion dirhams in documented price cuts. Currently listed, not projected. Current. Entry prices in key areas are down by 10 to 15% from the peak of 2025. Here's why that matters for yield. Yield is rent divided by purchase price. Peak entry price as denominator, you get a lower yield. Corrected entry price today, same rent, lower price, your yield improves significantly. A property yielding 7.2% gross in 2024 might yield 8.3% gross on today's entry. Same property, same tenant, different entry math. Every guide posted in the last couple of years is working with the wrong denominator as of today. And then obviously there is the supply. 65,000 units coming into the buy by year end. Some areas absorb that supply easily, some don't. The gap determines whether your 7% yield holds or starts compressing by the following quarters. JLT, gross rent about 8.5%, net 7%. Supply risk low. JLT is the most straightforward in this group. Gross yields right now are around 8.5%. Service charges are 15 to 17%. On a one-bedroom unit of around 800 square feet, that's about 12 to 13,600 units per year of your rental income. Rental yield is around 7%, and on corrected entry today, obviously it could go higher. Supply risk is low, JLT is built out. The DMCC ecosystem keeps demand consistent. Professionals, long stay tenants, repeat renewals, major new pipeline in the cluster. Most reliable net yield in this price brand. If I had to pick one of the areas where 7% net holds for the next 3 years, JLT is one of them. DLRC, gross is up to 9.6%, net 8.2%. Supply risk is moderate, best gross numbers in the group, active listings at 9.6%, service charges between 10 to 12%, lower than most areas, and after charges around 8.2%. That is your real yield. Supply exposure is moderate. Pipeline is phased, not sudden oversaturation in 2026. Highest risk adjusted net yield in this group. If yield is the primary objective, DLRC is one of the places I would look at. Arjan, gross 7.5%, net 6.2%. Supply risk is elevated. Arjan has had a lot of attention 3 years ago, and now the rental yields have started to drop. So, gross yields is around 7.8%. Here's where it gets a little complicated. Service charges in some Arjan buildings are 17 to 20 dirham per square foot. That's not cheap. After changes, net yield drops to 6.4%. And the supply story concerns me. Multiple developers building in parallel. Not a supply-constrained market. When 65,000 units land in Dubai by the year end, Arjan absorbs a share. More supply means more rental competition, and then that eventually leads to rental yield being compressed. So the yield works today, more pressure coming in 2027. If you're buying in Arjan, developer matters, floor plan matters, not all Arjan products are going to be equal. Jumeirah Golf Estate is about 6.5% gross, net 5.3%. However, supply risk is extremely low. Jumeirah Golf Estate is a different kind of play altogether. Gross yields are about 6.8%. Service charges, depending on the villa cluster, vary from 10 to 20. On a townhouse of 2,500 square feet, you're looking at somewhere around 25,000 dirhams per year. So your net yield is going to be somewhere around 5%. Is that bad? Not for what Jumeirah Golf Estate is. It isn't a yield-first area. It is a total return play. Capital appreciation alongside yield. Quality tenants, long-term leases, supply constraint, no major new builds nearby. So if 7% net is your objective, maybe not the right area or the wrong tool for this job. If you're building a portfolio and want an appreciating villa that pays you while you hold, Jumeirah Golf Estate makes sense in the mix. So 6.8% gross yield. Here's where that number comes from. Off-plan projections, anticipated rental rates, not achieved rents, entry prices before the March 2026 correction, all three inputs have moved. The rental demand story for Dubai Island hasn't fully materialized yet. It's a master plan development, still phasing in, infrastructure is still arriving. And let me say this clearly, I'm not saying Dubai Islands is a wrong long-term play. I'm saying if you're buying today for the rental yields, that's not a good play to be in. Again, with 65,000 units incoming, Dubai Island is carrying supply exposure, not insulation from it. The investors who will win here will be the investors who bought early, who bought with the right developer, and more importantly, who bought a differentiating product. Because a lot of developers have jumped into Dubai Islands, some of them with zero past record, selling at a similar price, competing with some of the bigger developers. And I feel like this is the area where we will see some of the investors making the most return. Some of the investors will barely be able to break even and sell at the price they bought at. Dubai Islands is the most interesting area right now, but selection of unit is very important. So what do you do with this? First thing, stop using gross yield as your decision number. Gross yield is what the agent shows you. Net yield is what hits your account. Service charge gap between JLT to Arjan, 3 to 8 dirham per square foot. Scale that across a unit, a year, a portfolio. You've lost yield before vacancy is even counted. Always get the service charges schedule before you model anything. Second thing, match the area to your holding horizon. Income now, JLT, DLRC, 5-year total return, Jumeirah Golf Estate, master plan patience, Dubai Islands with the right project, 3 to 5 years minimum, and supply risk or on a 2-year hold will be Arjan. Third thing, using the correction, about 2.36 billion in listed cart means motivated sellers. Pricing power is with the buyer today. Negotiate hard, price the exit, not just the entry. I'm going to give you my honest caveat in this. And I'm going to say this as clearly as I can. In a market like this, a lot of people are just looking at how much the prices have gone down from its original peak. That's not the right measuring tool. There were certain projects that were not priced correctly to begin with. And if you look at those gaps, and if you look at how much they have come down and take a decision based solely on that, it is not going to be a right move. So the methodology that I worked through today is gross yield, developer profile, number of finished projects, the numbers that will not shift even if the market softens a little bit. So how will I conclude all this? In my personal humble opinion, based on the experience that I have working in this industry for over a decade, working with hundreds of clients, doing transactions more than hundreds of millions of dirhams, if you're looking at Dubai as a yield investment right now, DM me, tell me which area you're watching, and I'll tell you with what I'm seeing on the ground.